Welcome back to the Innovator, the Imitator, and the Idiot. I'm Kyle Wong with Moxie, Colorado.
I'm Corey Martin with Bank of England Mortgage here in Denver, Colorado.
Thank you for joining us today. We are talking about different types of loans and what they mean. I'm sure you've heard many people talking about FHA loan, and you can do this and you can do that and you can house hack and whatever. But we're going to talk about all of the different types of loans and what that means and what that looks like for you as the consumer. And I'm excited to talk about it because I think there's a lot of information about it out there, but there's also a lot of misinformation about it out there. So, we're going to walk through cash deals, FHA, CHFA, VA, USDA, non-QM, conforming, qualifying.
Yes, qualifying.
Qualifying. See, I'm glad we've got this guy because he's going to be the one to educate us about it. So, where do we even start?
Yeah. I think that this is a great episode, right? Like, this is giving people the information that they need to make decisions, and information is ammo. And so we're getting strapped up here. I think that if we're going to talk about so when we're talking about loans, mortgages, the whole idea is like, look, it's the tool that you are using the instrument that you're using to purchase a home. All right. The idea is like, look, we're trying to buy a house here.
Yeah.
Now, if you don't have to obtain a mortgage,
then great.
Then awesome. I don't think you would. If you don't have to use this instrument to purchase a home, then I don't think you would. And what I'm talking about in that scenario would be a cash buyer.
Yeah.
I'm a loan officer. I don't know nothing about cash buyers.
Yeah.
Tell me a little bit about what it means to be a cash buyer. How does that contract look, or does it look any different than it would if you were purchasing a house with a mortgage?
That is a great question. So first and foremost, for buyers out there, or rather for sellers, that is typically considered the most attractive offer. And the reason why, first of all, what that means is you have like money in the bank right now that's liquid, or Bitcoin or whatever, to go towards a house. So you have a $500,000 house, you got at least $500,000 in the bank account. Boom, just like that. Funny fun fact actually is that if you have cash, like if you literally had that much money, if you go to a title company, you have to wire the money. You can't just write a check for it or like bring in stacks of money, which I always find hilarious because when people say like a cash deal, they're like, oh, so I have got to go to the bank? No, you don't.
As a matter of fact, don't go to the bank.
Yeah.
Also, I just also think of just walking in with briefcases, walking into
and I've heard stories of it before. Like people literally, somebody did that, like brought a bag full of money, totally legit, just like an older guy who wasn't used to the process. Nobody told him. And so, in those deals, typically you can write a cashier's check for good funds. But if it's an all cash deal, you've got to wire the money to the title company. Yeah. But anyway, so it's typically an attractive offer because not much can go wrong in the deal with financing, because in a typical deal, about, let's just say 30-day close, like you've got the appraiser going out there, you got to get things pre-underwritten. There are a few qualifications that the house needs to go through and you need to go through as the borrower, because the bank wants to know, hey, can this person pay me back the loan? And if things go sideways, if they default on the loan, can this house be provided as security for that loan? Right. So with cash, you don't have to worry about any of that. No appraisal, none of this. Like you don't even need to get pre-qualified for a cash deal, obviously, because it's your money. And so that is typically the best way to go if you can. But some other options may include, let's just say, a conventional loan. So what the heck is a conventional loan?
Yeah.
What does that even mean?
Right. And so conventional loan is generally the instrument or the loan type that's used to purchase most houses. All right. So there's several different loan types. Kyle mentioned them. I mentioned them: FHA, USDA, VA, non-QM, all of those things. But the conventional loan is the loan that, is the most popular one, or the one that's used most often. It does require a 3% down payment. right? So if you're looking at purchasing a $100,000 house, I like to use round numbers. $100,000 house, you would need $3,000 as part of your down payment.
Yeah.
That does not include the closing costs or anything like that. We're just saying, look, as part of your down payment on this home, we're going to say that, we need 3%. We do generally require higher credit scores versus like an FHA loan. Generally, we're talking about 620 credit scores. And then there are also county loan limits for conventional loans. And I know that we just raised them for Denver, and I forgot to Google it. Give me a second. Kyle, who's your favorite band of all time?
Is it 787? Red Jumpsuit Apparatus.
I love those guys.
Yeah.
What was the single that they had?
I don't know if I would say my favorite, but that's what came out to me.
I saw them live at Voodoo Fest New Orleans 2007.
You're kidding? You saw them live?
Yeah, man.
Wait, 2007? That was like their heyday. That's like perfect.
Yeah. Yeah.
Bringing back some good memories there.
Yeah, another gray hair just grew. So for I think 787, I think, is what they were going to for 2023. I do know that for 2022, it was 647.2, right? And so in order to purchase a conventional loan in 2022, the loan amount could not exceed $647,200, right?
Yes.
So, the other part to conventional loans is that they require, or you have to be under a 50% DTI, debt to income ratio. And so what that means is if you make, $10,000 a month, I love round numbers. If you make $10,000 a month, then all in, the mortgage included, all of your debt, your car payment, your credit cards, your student loans, not your cell phone bill, that doesn't count as your debt to income. But all of those things that are showing up on your credit report, for example, can't exceed more than $5,000 in this scenario, right? Because that would be 50% of the $10,000 that we're talking about, right?
Yeah.
So that's what we see on some of that's the most popular loan, if you will, right? That's the loan that the majority of homes are purchased with. The next most popular loan is the FHA loan. And there are two different loan types, right? Conventional FHA. The FHA loan does require a little bit of a higher down payment because the credit scores, floors are a little bit lower, right? Yeah. And so if you have a lower credit score, maybe you're around that 600 level or something like that, then it would make sense to qualify for a FHA loan.
Yeah, and just to touch on that really quick, he's mentioning, credit and income and down payment. Really quick, down payment is an important one because it's kind of showing that you've got skin in the game, right? Like your down payment is saying, hey, I'm serious about this. Let me show you in finances how serious I am about it. And so that can be a very good thing up front for you as the borrower, just because you are automatically going into that house with equity, meaning that is money that is in the house that is yours when you go to sell, as opposed to paying off interest for a loan.
Absolutely. And I mean, that stuff is important, when we're talking about the skin in the game, the risk that that your loan presents, right? Like if I'm the bank, the more you put down as your down payment, the less risky it is for me. So the less risky it is, maybe I can give you a little break on your interest rate.
Yeah.
If you are going to, for example, put down 20% on as a down payment, well, shoot, I should probably help you out and give you a little bit lower interest rate. And so that's one of the things that down payment can do for you. And that's why on an FHA loan, because the credit score may be a little bit lower, there's a higher risk. So we're going to need a little bit higher down payment. So 3.5% is the requirement there. Another thing that makes an FHA loan a little more attractive is that it allows for bankruptcies. The window for bankruptcies to qualify for an FHA loan is much shorter than it would be for a conventional loan.
Right.
And so there's a little more leniency if your financial, picture isn't as beautiful or as easygoing as, some other folks is. You can still purchase a home with an FHA loan. That option's still available for you. The other thing about FHA loans are they do require upfront mortgage insurance. And so that again speaks to the risk that the bank is taking on by saying, okay, look, maybe a little bit lower credit score, maybe you haven't demonstrated the same ability to repay that other borrowers have. So in order to give ourselves a little more cushion here, we're going to charge you a little bit up front, and then you can and you'll pay us back on the back end.
Yeah.
As far as the difference between conventional loans and FHA loans, we've talked about, what it looks like for me. But, let's say you've got, a conventional buyer and an FHA buyer. How does that change the offer that you write up for them?
So on my end, it changes things a little bit just because with a conventional loan, you can typically close a little bit sooner than you would with an FHA loan. And here's why. Appraisers usually work a little faster on a conventional loan. And then FHA loans, with their guidelines, since they are a little bit more flexible with their borrower, the house needs to be within a certain set of guidelines that are a little bit more strict than conventional loans. Right. And so things like the siding of the home, the condition of the foundation, obviously you don't want a broken foundation, but things like settling. So if you've ever gone to a house where the driveway is 4 inches higher than the sidewalk or the step up to the front of the house, things like that may potentially be a problem for an FHA borrower, because when that appraiser comes out to say, yes, this house is worth the amount that we're going to loan on the house, or no, it's not, they are a lot stricter when it comes to that. And that you're going to see it continues over to VA as well. They're pretty strict with that. But FHA, I think, actually is a little bit more notorious for their guidelines.
Yeah.
And absolutely. So when we're writing up offers, we want us as the buyers, we want to say, hey, it's good to work with us because of X, Y, and Z. And with an FHA loan, you really have to make sure that you're writing a polished, attractive offer, because sometimes there are things that could fall through. And as the seller, you want to know, am I getting the money that I'm wanting, and am I actually going to close on time? And so with an FHA borrower, you really got to make sure that deadlines are met, the house qualifies, everything's good to go. So you just have to keep an eye out for that.
Yeah, I mean, it sounds like there may be some houses that you wouldn't even write up an offer on if you had an FHA borrower. Yeah. Versus a conventional borrower, you may say, okay, well, look, this one, there's some work to get done on this one, but we can look past that.
Exactly.
Past that, and with an FHA borrower, you may not necessarily do that. And here's the thing with FHA loans, they're great loans to help get you into the home, right? They get you into the home. They get you. The idea is, look, we want to make you a homeowner. Now, we're not going to make you a homeowner just for anything, right? When a person, when we're talking about an FHA loan, generally lower credit score, or maybe maybe they have some sort of bankruptcy or something like that. So the need to purchase a home or the desire to purchase a home may be a little bit greater than that person of a conventional loan. And when the desire is there, people want to take advantage of it.
Right.
And so that's something that for me, I look at some of the FHA guidelines as not necessarily I look at them as good things to keep my borrower from being taken advantage of, particularly as, there are people who, may be looking for someone like my borrower to take advantage of.
Yeah.
Another loan that you mentioned that has a lot of guidelines to protect the borrowers would be veterans loans, VA loans. Mm-hmm. I personally think of veterans as a marginalized group in society.
Yeah,
and
100%.
so, tons of people out there that would take advantage of a veteran. And so with that being said, we want to make sure that we protect them. We have certain guidelines in place that we need to protect them. We need to, make sure that other people aren't going to take advantage of them. Talking a little bit more about a VA loan. A VA loan is accessible for any person that's actively in the military, right? And so that's, United States Marines, Army, Air Force, Navy, Space Force,
Coast Guard,
as well. So I don't know, is the National Guard eligible for a VA loan?
That's a good question. I don't know.
So
I'd like to assume so, but I don't know.
I'm not sure, and I'd hate to speak on it and say that they were if they weren't, and I'd hate to say I hate to say it's one thing when it's really not. So maybe you can look that up for me, Kyle.
Yeah.
But so they're eligible for active duty. Also for folks that have been discharged from the military or previous veterans. 100% financing available. And so when I say that, that means down payment requirements don't exist, right? And so they do, like I said, they have 100% financing available. There's no mortgage insurance like there would be for the FHA loan, but they do have a funding fee.
Right. And just really quick to go back to that, because you had mentioned mortgage insurance earlier, sometimes called private mortgage insurance or PMI.
Mm-hmm.
Just to go over what that is, it's essentially a fee when you don't put, I think the minimum is about 20%.
Yeah.
When you don't put 20% down towards a loan, it's kind of an extra insurance that the lender is saying, hey, we're going to charge you a little bit just in case things were to go sideways.
Right.
And that's why. And so, I'm sure you've heard a lot of people say, hey, I want to wait until I save up 20%. That may not be necessary, but that's usually why. You just have to crunch the numbers and see if it makes sense.
Yep, see if it's doable for you.
Yeah.
And so the funding fee on VA loans is essentially the same thing. It's to protect the lender, should things go left. That said, there are some veterans that are exempt from the funding fee. So, it's great. It's really, really important if you're a veteran thinking of purchasing a home to look into this, to ask your lender what's the requirement to get into your DD-214 and your certificate of eligibility. That'll give the lender the information that they need to determine what your funding fee is. The credit requirements for VA loans are not much lower, but lower than that of conventional loans. Here's the other part about VA loans is that you can use it multiple times.
Yeah.
You can't necessarily use it for two homes at the same time,
sure,
right?
Because it's got to be your primary residence.
Yep,
Yeah.
It's got to be your primary residence. But, let's say you are a veteran and, you just, you're in the military in South Carolina. Just, a lot of military folk in South Carolina, and you've decided, you've just, served your tour, not your tour. You've just completed your contract requirement. And
You've done your time.
You've done your time, and you're ready to move back to Montana. So you bought a house in South Carolina while you were there, and now you're ready to move back to Montana. You can still use your VA loan the second time for when you're moving back to Montana. So, again, it does have to be your primary residence, but the idea is that, hey, look, we're going to make it as easy as possible for our veterans to be able to purchase homes. Great. It's a great loan, great opportunity. If you are a veteran and, there's any idea of where you're going to be for the next 2 to 3 years, I'd recommend using your VA loan.
Yeah. 100% agree. I was literally going to say that. Just, it's a great program. It's a great loan. It's a great option. And with that, like you said, there are potential downsides and people that want to take advantage of that, unfortunately. And during the 2020-2021 market, we saw a lot of people that it was really unfortunate working with VA buyers, because on my end, a VA offer could have been potentially one of the least attractive offers. And let me just say why before I go into the buyer side of things. So as the seller, you just want to know you're getting your money and it's going to close on time. Mm-hmm. With the VA, they send out their own appraisers, right? So it's not somebody that the lender hires out. It's a particular group. And so they can be very strict on their guidelines as well. And, with that, sellers that have cash offers or other conventional offers that know they're going to be a little bit more lax are like, okay, so I have a higher close rate or a chance of closing with this person. Why should I go with you? And that's really unfortunate because, like you said, it's a marginalized group of people that have done a lot for us as a country, and it's hard to see people, turning them away because of the type of program they're using. So that was hard.
Yeah.
But also, as the buyer, that can be really awesome to go into a house with very little, with zero down potentially,
right.
Just paying closing costs. And even now, we can get some closing costs covered by the seller, and it's awesome. So yeah, if you have it, if you're a veteran, thank you for your service.
Yes.
Please use it. Please do.
Peace, Ryan. We got LOs leaving, folks. But no, so that's, it's a great loan. Great opportunity, especially as the market has shifted a little bit. We've talked about this on other episodes where you can get some seller concessions. For a veteran, you can get into a home for like next to nothing.
Actually, you just start making your payments in 2 months, and that's it.
That's it. What a blessing and great opportunity. Another loan that has 100% financing available is a USDA loan.
Yeah.
And it's not as popular, not as many people are aware of it, but let me tell you, when it comes down to just a great way to get into a home, the USDA loan, depending on where you're looking, is a great option for you. USDA loans are backed by the United States Department of Agriculture, USDA.
Hence the name.
And they are for rural areas, suburban and rural areas only. And so, look, if you're looking to purchase a home with the USDA loan, you probably can't do it out of any house that you see out of the back of here, right?
Yeah, you're going to be way out there.
Right. There are certain population requirements for the area that you're looking to purchase in. So they, if you are looking to use it, just contact the lender and have them look up the property on the USDA website. It's perfectly, easily accessible.
Yeah, and it is nice because that's another 0% down option potentially.
Yeah.
But again, with that, we always say this because we want people to get the full picture, not just, it's the end-all be-all solution. With zero down, having less skin in the game, it's a lot easier for you to be upside down in your loan.
Yeah.
Meaning you are owing more than the property is worth that you're borrowing for.
Right.
So just keep that in mind with VA, with USDA, with a lot of the low down payment options. Just keep that in mind if you plan on selling within 2 to 5 years. Just keep that in the back of your mind.
Yeah, absolutely.
Anyways.
Absolutely. And that's the thing with USDA loans is that if you're going to use that, then, plan on, you probably want to stay. It's a conversation that your realtor and your lender should have with you, but you probably want to stick around for, plan on being there for a little bit.
Yeah.
Other things to keep in mind, is that, or the biggest thing is that it does require you be under the area medium income limit. And so you can't make too much money and use a USDA loan to purchase a home, right?
Right.
You can't be, pulling in, we'll say, $1 million a year, just because it's an easy round number, $1 million a year and look to qualify for a loan with zero down, right? That's not who the loan was meant for. So, lower credit requirements, 640 as far as the credit requirements. So, not a little bit higher actually than the FHA.
Because that's 620, right?
Yeah. Or the conventional 620. FHA can technically go down to 580, although not all lenders go that low.
Sure.
Usually it's about 600. It's about the number. So,
pro tips here.
Yep, pro tips. So that's the one. And so that's the biggest thing with USDA loans is that you can't be over that county loan limit as far as the income goes. When we're talking about other loans that don't require that we don't really care about your income, that's when we're getting into the non-QM space, which is really a great tool for folks who want to get into a home, but maybe need to be a little bit more creative about how they do so. Mm-hmm. Non-QM means qualifying. Oh man, look, this guy.
I know.
This God. But there are a few different types of loans that fall under that non-QM space. Bank statement loans, where we aren't necessarily looking at your pay stubs to qualify you, to say how much money you can make. We aren't looking at your W-2s or your tax returns. We are looking at your bank statements. Well, what's going into your bank account and what's going out.
Yeah.
And that's how we qualify you to purchase the home. Asset qualifier loans, where we literally, similar to a bank statement, but we're looking through your portfolio of assets to say this person has the funds to be able to purchase this home and make the payments, right?
Yeah, which those are both great options. I'll just say, like, from a application standpoint, for usually what I've seen is business owners.
Yes.
Like people that are 1099 or have their wealth built up in assets and businesses and other things, and don't necessarily have a high income, or they're, are doing things in a way for tax purposes, usually is what I see. Or if it's a recent business, right? Like some people go from a W-2 job to a 1099 and you want to do a bank statement loan or something like that, because they have the funds and they're willing to pay for it. It doesn't look like it would traditionally for some people who just have their, W-2 job. They get paid every other Friday, stuff like that. So.
Yeah, that's it. Great option for real estate agents, right?
Me, I would be the guy who might use that if it's less than 2 years in.
Yeah, that would be it, right? We also have other loans that fall under the non-QM space. I-10 loans, so loans that are for folks that don't have social security numbers, right? And so any of our foreign nationals. You can absolutely still purchase a home. And then the DSCR loans, right?
Yeah.
So loans that, again, we're not using your income to qualify you for the home. We're using the income that the property is going to generate to qualify you to purchase the home. And so with all of these non-QM loans, they do require a little bit more, require higher credit scores and generally require higher down payments. Mm-hmm. So 10 to 20%. Across the board on these, and lower you go on those with your down payment, the higher you can expect your interest rate to be.
Right.
And so, great option again as far as like getting into a home if you don't want to necessarily produce pay stubs, or you can't produce pay stubs to show income for your debt to income ratio.
Yeah,
we can still put you into a home. It's just a matter of, hey man, we're gonna need your bank statements.
Yeah, another thing is assumable loans. So in the recent market, we've seen assumable loans come back. There's a lot that goes into assumable loans, like silent assumptions and all kinds of funky like wraparounds, things like that. So real quick, an assumable loan is when the owner, the seller of a house, has a loan that's very attractive. Let's just say they bought 2 years ago when it was like 3%, 3.5%. And this new buyer says, hey, I really love your house. Can we talk about the terms of assuming a loan? And so what often happens, again, there are very different assumable loans, silent assumptions, all kinds of stuff. But typically what happens is the seller works in agreement with the buyer and they say, hey, what I'm going to do is I'm essentially going to take your place and assume your loan in this house at your current interest rate, as opposed to me getting a new loan at whatever the current interest rate is, like 6.5%, 7%. And that's very attractive for people who have a great loan in the house that they're in already.
Yeah.
Now you can do assumable VAs. That one's a lot more complicated because of like your certificate of eligibility. And then the other thing is there's also liability on the seller and the owner of the house, right? Because you want to make sure that person makes payments, and so all of the legal things that go into that, but that's also another option.
Yeah, I mean, aside from the fact in the VA case, they got to be a veteran.
Right, exactly.
Right, they got to be a veteran. I know that FHA loans are, some FHA loans are assumable as well. And so that's a great option, especially like, if you bought in 2020 or 2021, not that you're looking to sell your home right now, but if you are, that can make your home that much more attractive to to a borrower, because if you bought in 2021, chances are your interest rate's around 3%.
Yeah, and so that's exactly right. If you are looking to attract a buyer, maybe they can't even afford your house at the current interest rate, but if they assume your loan, then they can, because they'll have a lower payment. So
this is the idea here is to make sure that you are aware of all of the different avenues and ways that we can get you into a home. The idea is like, look, purchasing a home is a good thing for you. You don't necessarily have to have 20% down and have, 100
Dang it,
grand
Dave Ramsey.
Right? But you don't have to have 20% down in perfect credit and, 100 grand in the bank liquid to purchase a home.
Yeah.
As a matter of fact, if you're a veteran, shoot, save your last paycheck. You can probably get into a home.
Yeah, I was going to say, like, with CHFA, that's another thing I wanted you to talk about because you know more about it. Like, as little as $1,000. Like, if you got $1,000 and you've got a job, you can probably get into a house.
Yeah.
So, yeah, talk about that.
If you got $1,000 and a job, you can probably get into a house.
Boom, that's it. Thank you for joining, everybody.
It's that simple.
Yeah.
I mean, so there are some other requirements, or not requirements. Down payment assistance programs are subject to county loan limits. They are subject to income limits as well. They do require a first-time home buyer class as well. You do have to be a first-time home buyer. That doesn't mean that it's actually your first home that you're purchasing. It just means that you haven't owned a home or been on title in the last 3 years.
Yeah.
That's those are the biggest things. It does, like we said, $1,000. You do have to have some skin in the game. Again, it's the risk, right? The more money you put down, the more risky it is for you.
Mm-hmm.
The less risky it is for me. And so if you're not going to put any money, you don't have a ton of money to put down, that's fine. We recognize, especially in this economy, that not everybody is able to save 20 grand.
Yeah.
That's what down payment assistance programs are for. But again, we still need to have, you still got to come out of pocket on something.
Right.
And so that's it. I think that's the down payment assistance programs across the board generally. Like not just Metro, DPA, or CHFA.
Sure.
I'm working on another down payment assistance program out of Michigan.
Yeah.
There's national down payment assistance programs called the Shinoa Fund that's available, and it's the same concept that you've got to be able to put a few bucks down yourself, take a first time home buyer class, and you can't be making $1 million a year and asking for us to, let me borrow a few grand to put down on this home.
Yeah. We don't want anybody taking advantage of loan products like this. Like, that's why we have so many options for people. Is like, not everybody's in the same financial circumstance, so it's nice to have these options. And so, last thing, I know a lot of people are like, you know what, sure, that looks great, like payments are good, might even be less than my rent, but how do I come up with closing costs? Like, I hear I have to put 20% down, or I have to spend 10 grand just to close on a house. And while there are real closing costs and there's a real down payment for most programs, we just talked about a couple of the down payment solutions, but also another solution for closing costs is just loan or interest rates is loan buy downs. So there are temporary loan buy downs, and there are also permanent loan buy downs. Can you just go through real quick what the heck that means? Yeah,
so when we're talking about a buy down, what we're saying is this is your interest rate, right? Your interest rate is 6%, and we are going to take funds, and we're going to buy it down, from 6% to 4%. Right? That's exactly what a buy down does. And so if you have a buy down, it allows you to, let's say you have, 10 grand that you were got 10 grand available, you can use the buy down to buy down your interest rate and use that 10 grand towards closing costs. It's a great option there. You can do it permanently or temporarily. So you can temporarily, or you can have a permanent buy down, right? Where, the interest rate when you purchase the home is 6%, but you're buying it down to 4%, and your interest rate is 4% for the next 30 years for the life of that loan. Mm-hmm. Or you can have a temporary buy down, right? Where the interest rate is 6%, we're going to buy it down to 4%. But when it comes back up to 6% after 2 years, we're actually going to refinance you so you don't actually end up paying that 6% interest rate.
Yeah, and the reason why that's a big deal is because often financially the biggest hurdles that you hear about when buying a house is the interest rate, right, or the down payment. So there's always a qualm. So really at the end of the day, I'm not saying it doesn't matter, but often, does the payment fit within my monthly budget, right? Can we make that work? And do I have enough money liquid to close on the house?
Yep.
Right? So buy downs are super, super valuable, especially right now,
Right.
because oftentimes a seller can pay for your closing costs, or they can pay to buy the rate down,
Yep.
right? So maybe you couldn't afford the house at 6%, but you can afford it at 4%.
Yep.
So the seller, if you've got the money in the bank, by all means, buy it down, do a 2-1 buy down for the next couple of years until you start making more money, or have the seller negotiate with the seller, say, hey, maybe we'll pay list price. However, would you be willing to do a $10,000 concession or credit at closing where that can go towards a buy down?
Yep.
And so that's a very valuable conversation to have, and another tool in your tool belt as a home buyer, because maybe you make great money, you just don't have a ton saved.
Yeah.
Right? So there's an option for you there. Or maybe you've got a ton saved, you're just not making a ton, so you're very fiscally responsible, it's just not coming in every month. And that's fine, because either way, there's an option, and that's why we go through this, because I know this is kind of like drinking from a fire hose. There's a lot of information, but we just want to share options with you, because that's what we do. That's why it's so worth a conversation. If you're even remotely interested in buying a home or building wealth generationally, yeah, that's a big one.
I got you.
It's worth the conversation, and that's why we always say that. Like, I know that sounds so cliche, but we want to explore every option we can to help you achieve your financial and real estate goals.
Yeah,
that's why we're here.
That's why we're here. No matter what loan you're going to use to achieve your real estate goals, be it a VA loan, a jumbo loan, or a non-QM loan, just remember, in every market, there's an innovator,
an imitator,
and an idiot.
Thank you for joining, everybody.
I'm Corey Martin with Bank of England Mortgage here in Denver, Colorado. If you have any questions whatsoever about personal finance or real estate or mortgages, please don't hesitate to reach out to me at Corey Martin on Facebook or at Mortgage Consultant on IG.
Yeah, and I'm Kyle Wong with Moxie, Colorado, and you are welcome to reach me at the link below. You can schedule a call, and you will get us, not some automated call center or anybody. You'll get us.
Your boys.
We'll talk soon. Thanks, guys.
See ya.